everyone, and welcome to this direct instruction for Unit 5 on capital structure. Today I'm going to go over a couple problems from the end of chapters 11 and 12, just to give you guys a little bit of understanding on some of the things that you read through and some of the problems that you'll be working with at the end of the week. At the end of this session, a learner should be able to understand the M&M perfect capital market assumption, determine the value of an all-equity firm, and should be able to calculate stock price. So we're going to go right ahead and get into the problems. According to M&M, in a world of perfect capital markets, what will be the expected equity return or cost of equity for a firm that has a cost of capital of 10%, a cost of debt of 6%, debt valuated at 1.2 million, and equity valued at 1 million. So one of the best things to do is always start with what you know. You do know that your cost of capital is 10%. Your cost of debt is 6%. Your debt is valued at 1.2 million. And your equity is valued at 1 million. We also have our equation here. And ultimately, all you'll need to do is plug those numbers in there, and you'll come up with 14.8%. Okay, next question. How will your answer in number 3 change if we now relax the M&M perfect capital market assumption and incorporate a corporate tax of 35%? Once again, start with what we know. And ultimately, this equation is going to change a little bit because we are going to add in the tax. Once again, you plug those figures in, and you'll see that now you're looking at 13.1%, which should be expected. Ultimately, if we're adding an outside factor, that should be something that's going to lower, your percentage there. Okay, chapter 11, question 9. What is the value of an all-equity firm that has a dividend payout ratio of 100%, is expected to generate net income each year of 1 million, and has a required equity return of 16%? All right, so starting with what we know. And also, we're going to be using the dividend discount model equation. The reason G here is listed as 0 is because the dividend payout is 100%. Anything under 100% would cause this G number to increase. And we'll see that in a later problem. So once we plug those numbers in there, we'll see at the value of an all-equity firm is $6.25. Okay, so now suppose that the firm in question 9 has a payout ratio of 30%. Giving the earnings retention, what will be the next year's dividend? At what rate will the firm be able to grow the dividend? And what will be the value of the firm? And also we're going to compare these answers to what we got in number 9. So this problem's answered in actually two different parts, because the first thing we'll need to do is calculate G. And what we'll use for that is the sustainable growth formula. We know that 16% was from the previous question. And then we know that our retention rate is always going to be 1 minus the payout rate, which is what gives us 70%, which is your figure here, which gives us a 11.2 G. Next, we're going to recall the dividend discount model that we used previously. This here just shows, the information that we do have now, as opposed to having a 0 G now, we have 11.2. Also, our DIV is now 0.3 as opposed to 1 in the previous question. Plugging those answers in, we get a total of $6.25. All right, so now moving ahead to chapter 12, and this is question 1. Assume that a firm's earnings per share are estimated to be $2 next year, and that analysts have determined that an appropriate forward-looking multiple is 15 times the projected earnings. What should the stock price be? So we do know what we have here. We know our appropriate forward-looking PE multiple is 15. And we also know our earnings per share is $2. The equation we're going to use here multiplies these figures, which will give us a stock price of $30. Now suppose that the firm in question 1 plans to increase the proportion of debt as a part of its capital structure. The projected earnings per share would then be $2.50. In a world with no financial distress, determine what the stock price should be and explain why in real world that the stock price would be less than that amount. So once again, our appropriate forward-looking PE multiple is 15, and our earnings per share which is given to us in this question, is 2.5. Multiply those out using the exact same equation we used in the previous question. And we get a stock price of 37.50. The second part of this question asks, why would this not be the answer in the real world? And the reason is because if anytime you add any outside, financial distress to a stock price, it will cause, some variation in the price. So ultimately, if you're looking at things in a perfect world, using an equation like this would always help you get the stock price. But because we don't live in a perfect world, things happen with companies, things happen with their leadership, things happen with the government, things happen with their competitors. Because of all those outside factors, using this wouldn't actually normally wouldn't give you the exact price of a stock. All right, so that's all I have for you guys today. I know we're coming up on the final week of the course. If you have any questions or concerns, feel free to reach out to me. I'd be glad to help you. Other than that, have a great day and look forward to working with you guys again.